All right, all right. Good morning, everyone. We had our nice options class last night, and I think it turned out pretty well. A few people walked out with their tails between their legs, but most everybody was pretty happy, I think. It gets a little complicated sometimes when you first get introduced to options, and that is the truth of the matter. Nobody's going to pull any punches there on you. It can be a little bit overwhelming at first, but as you start to use them a little bit more, you realize they're not really the complicated, scary thing that everybody makes them out to be, or that they seem to be. They just kind of takes a little bit to get used to. And then once you get used to them, they're just second nature. They're pretty darn easy, actually. You're going to have a light bulb moment, I promise. You're just going to go, "What? Oh my gosh! Why did I not see that?" It'll come, I promise. You'll have a little light bulb moment. But if you don't stick to it, if you don't just keep coming and watching and learning and playing and getting your own software and practicing so that you can do this yourself, then that little light bulb moment won't ever come. So you got to just keep sticking to it and just realize that, okay, I'm going to learn options. I'm not going to trade them right now. That's fine, but I'm going to learn them. I'm going to keep practicing. That's what demo account's for. So we got a bunch of options on in our demo account. We've been playing with options in other lessons and other classes. And so we got a whole bunch of stuff in here. We're going to go down through some of them. We're going to clear them out. We're going to get rid of them. That's what a demo account's for. And we're going to put new ones on. All right. We're going to follow and track them. And we're going to go. You come back next time we have a lab and we'll look at them again and we'll see what they're doing. That's how you learn. You just got to put them on. And a lot of people are scared to put them on. They're like, oh, I'll put one on and see what it does. No, you go in. If you're going to do a strategy in in the demo, you're going to put 30 of those things on. All right. That way you learn 30 times faster. You got 30 different markets. Go put 30 of the same thing on in all 30 markets and watch what happens in 30 markets. That way you learn 30 times faster. If you're just going to go put one on, you're only watching one market. Well, that's great, but you're only going to get one experience. But if you can put 30 of the same thing on in 30 markets, because it's a demo account, who cares, right? They're just going to give you more money if you run out. So you put 30 of them on. Now you got 30 experiences with the same strategy all at the same time. That's a lot faster way of learning. So just keep that in mind. All right. So we want you to learn fast. So Wiley Coyote, he's coming up and saying, I can't wait for the light bulb moment. Yeah, it'll come. I promise. I promise. And it's going to be a dramatic one. You keep doing it. I promise. It'll be a dramatic. It's not going to be like, I think I'm getting this. I think I'm getting this. No, it's going to go like, I'm not getting this. I'm not getting this. And then it's going to be like one day you're going to come in and you're going to go, bam, the whole thing all came together at once. And you're just going to go, I promise. That's the way options are. It's like, I don't get it. I don't get it. I don't get it. I don't get it. And then one day it's like the lights come on and everything's easy. Okay. So we're going to go out and see if we can't make that light bulb come on for you a little bit faster. We're going to add a little bit more knowledge to you today. And so we're going to do that. All right, let's start with, I want to start down here with one of these that we already have, AXP. That's the one I'm going to start with. Now, the reason I want to put AXP on here is because this is one that we already been trading. And what we did is we came in here, and in this little spot right here, you can see what I did is I bought into the market. I wanted 100 shares, right? So we bought 100 shares right here in anticipation that the market was going to continue to rally up off of this backside. So we thought, well, it came up, down, right? And we're going to expect AXP to go higher. But then we were like, but this is a head and shoulders formation. It's probably going to fall and go back down. So we're like, well, if we want to get in here, we can get in with a few shares, but let's protect ourselves to the downside in case we're wrong. And so what we did is we bought 100 shares and then we bought a put. Now, remember, if you buy a put, if you think the market's going to go up, you want to make money when the market goes up, you buy a call. If you want to make money when the market goes down, you buy a put. So we bought 100 shares. And of course, if you buy 100 shares, that means you anticipate the market rising in price. But then we also bought a put. Now, a put covers 100 shares. That's why we bought one option and 100 shares. So the option, that covers us to the downside, right? It'll make money if the market falls. Now, the max amount of money we can lose on the option is the amount of money we paid for it, the premium we paid for it, which in this case was $1,685. And that's over a period of, I think when we did this, it was like, I don't know, it looks like it was about about 90 days. So we're going to not lose that entire 1,600 premium that we paid for it over a period of 60 days. And in the meantime, the market actually did flush down. So we're actually making money on our option. You can see we're up $4,200. So the premium, the value of that is $5,892. If we liquidate it, we're going to get $5,892. But the market went down. So what did we do? We came in here and the market went down. We lost money on our shares, right? How much did we lose? All the way down to here, which was those getting over the top of each other. $5,697. Oh my gosh, look at that. $5,697 is what we lost. And on our option, if we liquidate that option right now, they're going to give us back $5,892. I mean, that's pretty darn good, right? So we made 420. They're going to give us back part of our premium because we're not using it all because we still have 59 days left. So they're going to give us some of our premium back. So we get $5,892.50. That's the market value of our option that we had up there that we put on when we're actually making money when the market went down. Just used it as an insurance policy, right? So if you're long the market and you're worried the market's going to flush out from underneath you, then go ahead and buy a put option. And then if the market does flush out, you don't have to sell your shares, which is a taxable event, right? Of course, this is going to be a taxable event anyway, because we're going to liquidate this, take the profit, which is going to cover the losses of this one. But we could dollar cost average that, or we can tax loss harvest that at the end of the year. Don't worry about it. It's going to cover your losses. And that's what you're really concerned about. So we're going to come in here. We didn't lose anything all the way down. So that market went all the way down. We didn't lose anything. We're going to get $5,892 back. We lost $5,697. We actually made $200 during that fall. All right. So then what we're going to do, so let's go ahead and do that. We're going to liquidate this option, take our profits out of there. And I'm just going to see if they'll mark it out of us. Let's see if they'll let us have it off. There we go. Okay. So we just took our profits. Now what I did is I said, okay, I'm going to roll my option. Rolling just means you're going to liquidate this one and buy a new one down here. Now, I didn't liquidate this one until now. I wanted you guys to be able to see me do that. So we took that off and I added this one in down here and I bought another 100 shares. So now I have 200 shares. Now the dollar cost average on that brings my shares from the first 100, which was right here. And if I buy the second 100 down here, well, actually the average of those two ends up right there. All right. So that's how we ended up with 200 shares right there in the dead center of the middle of that trend, because we bought 100 shares down here. We bought 100 shares up there. The average brings it here. So now what we're going to do is we're going to get rid of all these arrows. Now we're going to come in and we're going to buy another put option down here, which I did yesterday. So we bought this put option yesterday. I didn't want to do this whole thing without you guys seeing everything. I started doing it, and then I was like, well, I got to meet more people than just the one or two that are watching this one. We'll come and do it for the whole class tomorrow. So that's why we're doing it now. Coming in here, and now we liquidated that. We take our profits, cover our losses on the 100 shares. Now we put on another 100 shares and put another option in down here. So now if the market falls, we'll be we only have one option, so it's going to cover only 100 shares to the downside, not 200 shares. But I'm way down here at the very bottom. Maybe it'll turn around and go up. If I want to, I could buy another option down here, but this one cost me $2,420. We could put another one in. It's got a current value of $2,220. So we're down $200. There's the $200 that we made right here. So we're down $200, but that's because the market's starting to rally, which means that our shares are going to go up in value, right? So our shares will now go up in value. If the market rises, our option will lose value. And now it probably won't lose value. Well, it won't lose value faster than what we're making it. So we'll still make money. We just won't make it as fast. And you can see that over here in the delta chain. Remember, the delta tells us we're just going to do calls. Go over here to calls. The delta tells us how many shares it's covering. So right now it's covering 52 shares, the option. Now, wait, let's get the right one. Where is that one? This is a 122. We got to go get the right one. So go out to 122 days, and it's probably in here somewhere. Where is our option at? Oh, that's a put option. We got to go look at the put options. So 122 days. Well, it's right there, that green line. That represents our put option. Now, that doesn't seem right. On American Express, it's saying we have 0 volume and 300 open interest. Is that true? Wow, that's not good. Okay, we have a rule of thumb. When we buy an option, we want it to be volume is at least 100 or close to it, and open interest be over 1,000. And this is telling us this is 537. We bought that yesterday. That option looks terrible. We can't buy that option. All these options, these put options are at 0. I don't think that's right. Man, they can't all be 0 on American Express. I think we got something, our volume's not coming through today. I know that Tradeer was having a little problem with their data yesterday. So we'll see. I'm going to double check on that for us after class is over and find out why volumes. Let's go look at a different market. Maybe it really is ARK. Let's go look at Apple. Apple's always got lots of volume. Oh, see, no, they got a problem. So yesterday, Tradeer was having a problem with their data. Look, volume 0 on Apple too. That's not true. So they're still working on their data. They've still got a little data issue. They had some data issues yesterday. They were working on their data. So Tradeer, which is the brokerage from the clearing firm that provides track and trade with its data. So it's not track and trade. It's nothing wrong with track and trade. It's the clearing firm is not sending down the data. They had a problem with their data yesterday. They've been working on it, trying to fix it. I think they were trying to make it faster and better, and they broke it. It's the way of programming. 2 steps backward, 1 step forward, 2 steps backwards, 1 step forward. That's how programming works. All right. So this is, we just can't work at the volume and open interest today. But volume, generally want that to be 100 and open interest 1,000. So if it's over 1,000, then we're this in here 7,000. Let's go back over to where we were with AXP. All right. So AXP is 537. It says the spread, and I don't think that's right either. It says the spread is 1.2 or $125. All right. We're having a little problem here, but we're going to work through it. This might just be the demo account. I haven't checked the real money account. I should have checked the real money account this morning. But this is a demo account, and maybe it's just a demo that's having problems. We'll see. Okay. Let's so we got our put option here. The only question is, do we want to have 2 put options to cover our 200 shares, or are we happy with 1 put option covering 0.42? So it's only 42 shares. And we have 200 shares. So right now, here at the beginning, if the market falls, then the option is not going to cover us at 100%. It's going to only cover us at 42 shares. Okay. So we have to keep that in mind. But the market's really, I'm going to wait for a little bit. I don't want to have to spend another $2,400 buying a share, buying another put option if the market turns and starts to go up. And then I'll lose more money, right? I'll lose double the amount of money. So I think right down in here, we're at a good spot. The little red dots have flipped to the other side. The yellow dots look like they're going to flip to the other side. It looks like we might get some rally out of here. It might take a little while. It might go through a little accumulation stage. It might go down through here and go sideways for a bit. So we'll just protect ourselves with 1. If it goes a little, it starts looking a little like those dots are going to intercept again on the red side, I'll probably put a second one on, just to be careful. Right. But let's do it anyway, because we're here. Let's go ahead and put one on right now. The way I would do it is I just come in here, and you could just come down here. There's several ways in track and trade that you can do that. Most platforms have several ways that you can get into the market. You can just come in here, right click, and say buy order. Right. So you're going to hit a buy order. Now that's not going to actually make a buy. It's just going to fill the order ticket. So it's going to put it into the order ticket up here, and then you can come in and bid for it with the bid and ask. Now, the bid and ask is right now saying $125, and I'm not sure that's true. I don't think that's true, given the fact that we've got some problems with volume and stuff. I'm going to say that seems a little off. $125. That's a lot. That's a big spread for American Express. I don't know. It might be right. But anyway, we could bid for it. We'd definitely want to bid for it if that's what it is. So we'll go to the midpoint. That'd be $63. We're going to place our order. And then they're not going to take it here in the demo account. They always make you go all the way to the asking price in the demo. But in the real money market, usually you can get a fill at the midpoint. So we'll go all the way up to $22.85, which is what they want to get this in here. And that's ugly. I hate that. I wouldn't do it. 85 if this was in our real money, $125 spread. You can't do it. Let's put it on there and see if they give it to us. Okay, so we got 2 now anyway. So we got two two short positions. So now we're protected to the downside. If the market flushes down, it'll make about as much money as we're losing up here because we got two of them, right? Just like it did here. We made all of our money back when the market fell all the way down to here, even though we were in way up there. So we added another 100 shares, average price. We're protected here to the downside. Now we want the market to turn and rally. If it starts to rally, we just get rid of these, get our money back. All right, we paid $4,700 insurance, but we don't have to use all that insurance. We can, if the market starts to rally and looks like it's going to go, then we can cancel that insurance and get most of our money back. All right, and then it'll be made up in the profits of the shares. Okay, that is AXP. Let's come over here to AMD. Now, AMD is a situation where we bought some shares, right? We came in here, we bought 100 shares right there, and we're worried that the market's not going to go up. So again, what we did is we come in and we bought a put option, and you can see the put option right here. Right there's our little put option. See that? So that's right there on the screen, and we got a put option. We bought it to the downside. Now we've got 122 days left on that. Now remember, the reason I like to buy 122 days is because the market has a tendency, this is called theta decay. So whenever you buy an option, it's immediately a deteriorating asset. So it starts to lose money. It starts to lose that value immediately. That's how you make money when you sell an option. When you sell an option, you make the money as the market decays in value. Now, they give it to you all up front, and we're going to do a little math tomorrow night in class. I'll do a little math for you, show you how it works. Well, let's do it right now that we're talking about it. Let's come in here. How many of you have been to accounting class? All right. You remember your basic accounting class? Or maybe you just do a checking book, check account. Does anybody still use these little checkbooks? I still have a checkbook. All right, so you come in here. This is your debits, right? Debits. We're going to put credits on the left, and we're going to put debits on the right. So we have debits and credits. So these are your debits and your credits. So what happens when you buy an option, right? Say you buy an option. I have little. This isn't working very good, but just think of it like this. You debit your account $1,000 for the option. We got all these little tails on here. That's okay. So you come in here, you debit your account $1,000. Well, that $1,000, as soon as you pay it, it goes over here to the guy that sold it to you. So he gets $1,000. So that's where the money goes. So that's how you get paid when you sell an option. So when you sell an option, you get your $1,000 from the credit from the guy who debited out of his account $1,000. So it goes from his account to your account. So it happens immediately. So as soon as you sell an option, you immediately get $1,000 in your account. But do you really have $1,000? No. And here's the reason why. Let's get this guy out of here. This is, go with him. So we're going to get this guy out of here. We'll use this one. Oh, wait, these are still debits and credits. But just think of this guy. His money went from his debit to your credit, but now this is your whole account. So you have a credit of $1,000, but you also have in your account a debit of $1,000 because you credited $1,000, but you also owe the market $1,000. Why do you owe the market $1,000? Because you also have time, and time is money. Right? You ever heard time is money? Well, this is the true sense of that. So time is money in here, and how much time do we have? Well, we have 120, this says right here, 122 days. So we have 122 days of time. And if you come down to track and trade has a column in here that's called premium per unit. And it's kind of it tells you that each unit is worth $24. So each day of that 2,400 of the 122 days is worth $24.05. That's how much each day is worth. So technically speaking, now it doesn't work exactly like this. This is just a premium per unit. But basically, because you lose a day every single day, right? You have 122 days. Tomorrow you'll have 121 days. Then you'll have 120 days. And then you'll have 130. Well, when you are the guy who bought the option, you are losing the $24 every day. And the guy who sold you the option, he's making $24 every day. Simple, right? Very simple concept. The buyer has to pay and the money goes immediately from your account that you paid to the guy that sold it to you. But then he owes you back the amount of days that you keep. It's just like an insurance company. If you cancel your insurance premium 30 days into your, or 10 days into your month where you paid your monthly premium, they give you back everything for the rest of the month. This is exactly the same thing. But you paid the insurance premium all up front on January 1st, March 1st, April 1st, you paid your full car premium. But then in 10 days, if you cancel it and say, well, I sold my car, I don't need it anymore, you can tell the insurance company and they give you back all the insurance for the rest of the month that you didn't use. Well, that's all that's happening here. You have your little T credit bill, right? You have your credits and your debits. Well, the credit came from him, went to your account. You now have $1,000. And then the way the credits go back is day by day by day by day. So that's how you make money when you sell an option. Every day you get that little $24. Now it's not going to be $24. I'm going to show you a little chart why. But it happens where you're going to just start swapping the money back again, one day at a time. That's how you make money when you sell an option. Every day you get a little bit of premium. And then when the guy who bought the option, every day he loses a little bit of premium. But you swap the major amounts at the purchase price. And then you pay back each other the amounts every day. Just like an insurance company. I know it sounds a little complicated, but that's how it works. Okay, so that's how insurance companies work. You understand your insurance company, you understand an option. Exactly the same thing. So let's go over. I'm going to show you a little chart here. It's called the theta chart. And the theta decay comes in, and we're going to go into the slides. Now you all have this set of slides here. This is what I call the supplemental to the manual. So this is the manual. All right, this is the manual of that you get that we gave you too. So you have the manual. You can get the paper version of the manual. You can get the paper version of the manual online at Amazon. Just go search Lan H. Turner. You get the paper version. And then this is the electronic version. There is no paper version of the supplemental slides for the manual. Okay, so you got this. And if you come in here, I've got in here there's a whole bunch of option stuff in here, and we're going to talk about all of this. So don't worry, it's going to all come to you. You're going to learn all about this. But what I want to talk to you about right now is I want to talk to you about theta. And theta is how fast the market time decays. And there's a little chart in here. Where did my theta chart go? Lan had it up here just a minute ago. What did he do with it? Oh, there it is right there. Okay, so here's your theta decay. Let's look at this one. So what happens is you buy it out here at 100 days. And see how it goes real slow at first. Your insurance company drops down every day the amount of money that you have to pay back. Remember, we're going the little debit credit thing. Every day you make less money when you sell it than you do way out here at 19 days. It goes really fast. See how fast time drops off? So you start pouring that money in a lot faster going across from debit to credit as you get closer to expiration. But back here between 100 days and 90 days, it goes really slow. And that's why we buy 100 days worth of insurance, even though we only might need it for 19 days or 20 days or 30 days. We might only need our insurance for 30 days, but we'll buy 100 days worth so that that number back there goes really slow and we don't lose very much time decay. All right. Because out here between 30 and 0, we lose it all really fast because you have to pay that to the seller. If you buy an option, or if you are the seller, you get to collect it. And somebody who sold you 100 days worth of insurance, well, at the first of the insurance premium, they don't get very much money. It doesn't move very much. So that's good for us who are using it as an insurance policy. So we'll buy a 100-day insurance policy so that we don't lose very much premium at first, because we'll know in probably a week or 2 or 3 whether we want to need that insurance. And we certainly don't need it for 100 days. So if we do, the markets will move. We'll readjust it in, when there's like maybe 40, 50 days left. 42 days is kind of the magic number. So the mathematical model where you start to drop off too fast. So about 40 days, you want to get rid of this thing and go back out and get another 100-day insurance policy. It's because it's 42 days where they really start dropping. All right. So if you're a premium collector and you're selling options, then keep that in mind too. You're going to, if you sell a 100-day, you don't get your money very fast until about 42 days. So might as well just sell 42-day options. And I think that's what Cody in our class was talking about, where he likes to do short-term selling short-term options. So that's because of that theta decay. All right, he gets his money a lot faster. So if you're going to sell options, but here we're buying the option, right? We're buying the put option. So we want that decay to be very slow. We don't want to have those give that money back very fast. So we buy 100 days out, and then we can not have to worry about losing too much money. And then if the market does go down, then we'll start making money on our option, and we have 100 days out there to sit there and collect money, just like we did on AXP before. So this is AMD, and we've got our long position. You can see we did this the other day. We put on a long, we just bought 100 shares, and then we bought a put option, because a put option makes money when the market goes down as a protection. We bought 100 shares because one option represents 100 shares of the underlying stock. So that's how much it protects. Each option represents 100 shares. But the delta is making or losing the amount of money as if it was 44 shares. But when it gets when it gets closer to expiration, which in this case is way out here, this purple line, then the delta will be 1.0. And if the market goes way up or way down, the delta, because of convexity, will become 1.0. I know it's a little complicated. There's a chart that shows it here. I got a chart that shows it. Well, this chart shows you going both ways. In the slide tomorrow in class, I'll have a slide that'll show you. But it shows you where your losers are and where your winners are. And this is one going. This is an iron butterfly. So it's a little bit different. This is all the losers, and then the winners are out here on the wings. But this is kind of the same concept. As you go through price and time, the market becomes more profitable, or you have a loser, right? It goes into losing because the market didn't move far enough. Or if it goes up, well, you made lots of money up in here, and the green goes up way up off the screen. So that's kind of the idea of a long call and a long put. I don't think I have that in here. I need to, on the supplemental, it'd probably be good. I got it in the slides. We'll see it on Wednesday night in class. I should probably add them to the supplemental. I'll do that. All right. So in the supplemental, we'll put just the longs and just the shorts, so you can see it just one and not a duplicate like this. Okay. So that is how these things work. Let's go put a few more on. I know it seems a little crazy, but that's how they work. Let's just go do some simple ones. Let's go into Apple. And first of all, with an option, we're going to come in here and we're going to say, I think Apple is going to go up. So you can do two things. If you think Apple is going to go up, you can just come in here and buy some shares. Maybe you want to buy 100 shares of Apple. If you do that, that's going to be $25,000. It's trading at $254 a share times 100 shares. That's $25,000, right? Robert says his light bulb is a little dim, but it's coming back on. So good. Just hopefully this is enlightening you just a little bit. They're not that complicated. You got calls and puts. That's it. If you think the market's going to go up, you buy a call. If you think the market's going to go down, you buy a put. That's it. Now you can buy a call or you can sell a call. You can buy a put or you can sell a put. If you think the market's going to go up, well, we're going to come in here and we're going to buy a put. If you think the market's going to go up, we're going to buy a call. We just come in here and buy a call. That's it. That's all there is to it. You just bought a call. Now, we haven't bought it. We just put the marker on there. And you come down here to your calls and you see, well, I got one right at the money, $1,735. And it's got a delta of 0.56, which means that it's going to start making money as if it had 56 shares. But as it gets closer and closer to the expiration, which is out here, that delta will go up. And because as you make more money, the delta goes up, which means you make more and more money per share, right? As you come down, the market will lose, delta will go down. So you start losing money more slowly. That's what's really cool about options. When you start making money, it'll start making money faster and faster and faster. When you start losing money, it starts losing money slower and slower and slower and slower. And that's convexity is the term that we use for that. But that just means the delta of the option is getting smaller and smaller and smaller, or bigger and bigger and bigger. Okay, and bigger means more shares that it's covering. And then by the time it gets all the way out to the expiration, it's gone all the way to 1.0. So it's covering 100% of your shares. That's just how they do it. Okay. I didn't make them up. That's just how they do it. So it's not like a 1-to-1 ratio. It's not the minute you buy it, you're not covered by 100 shares, but you are, just not until the end of time. So in the meantime, it just kind of grows. So there is your, and maybe, you don't want it to be 100 shares because then it'd be a lot more expensive for your insurance right up front. This way, the insurance is a lot less expensive in the beginning, and then it gets more expensive the longer you wait if you're using it as an insurance policy. So we just want it to make money. So that's all this is. If the market goes up, we make money, and we can have unlimited profit potential. It can go up as high as it wants. We just keep making money on our option, but only for 122 days, because we only bought the option for 122 days. And then at 122 days, we have to decide if we want to just take our profits from the option, which is increased in value, or if we want to exercise our right to buy the option, the stock at that price. If we want the stock, we can buy it, but we're going to have to come up with $25,000. If we don't have $25,000 to put into Apple, well, we're going to have to liquidate the option and just take the profit from the option, because the option will go up in value. Now, the problem is that the option has to go up faster than what it loses. Now, remember, when you buy an option, the guy who sold it to you, the way he makes money is that every day you give him some money. So you give him a little bit less at the beginning and a lot more at the end. But nonetheless, you transfer a little bit of money to him every single day. That's how it works, just like an insurance company. And so if you bought an insurance policy, that means the market has to go up, or if you bought a call, the market has to go up enough to cover the loss of the option, because the option loses money every single day, right? Every day you transfer a little bit of your income out of the cost of the option that you bought and give it to the guy who sold it to you. And then if you liquidate the option, the guy who you gave $1,000 to, well, he gets to keep the little bit that you gave him every day, maybe $20 every day. So he gets to keep 20, 40, 60, 80, 90. So he's made $90. And then you decide to liquidate and get out. Well, he has to give you all the money back except for the $90. He gets to keep the daily amount of money that he made. So he has to give that back to you. All right. So it works. And then you come in here and let's say you sell the option, you get the whole premium up front, but then you have to give it back you have to give a little bit back every day, right? Because he's making money. So what happens is what happens is the market has to go up. The guy who sells you the option doesn't have to give you money back unless you liquidate your option premium. Sorry, I misspoke that. So what happens is the market has to go up enough to make enough profit to cover the amount of money that you have to give to the seller every day on your option. So if you have to give the seller $20 every day on your option, $20 today, but maybe in 3 months you have to be giving them $100 a day, but today you only have to give them $20 a day. So $20 a day, every day you have to give him $20. But you gave him the whole amount up front, but that's the $20 he doesn't have to give back. So now the market has to make enough money to cover that $20 that you gave him every day. Otherwise you lose $20. Does that make sense? The option's value will decrease because of theta every day. It's going to go down. You're going to lose that $1,735 if the market doesn't go up enough to cover it. So you can be right in the market. That's one of the problems with options, is that you can be right and still lose money. So let's come in here and say $1,737. Let's get rid of this thing here. Where are they? So see that number right there? 1,700, there. $1,737. That's how much you paid for this call option, or are thinking of. We haven't bought it yet. We just put the calculator on there. So that means, let's come in here and get rid of all of these little arrows. Delete arrows, delete all drawing tools. So that means now what happens is the market has to go up by expiration. Now you don't have to hold it till expiration, but if you do, by expiration, the market has to go up by $1,742 just to cover the cost of the option. $1,742. That's about as close as I'm going to get right there. So that means that's your break-even point. But that's at expiration. That's not today. Because if the market takes off and goes up right now, you'll make money. It'll go up faster than you're having to give money to the seller, right, of the option. So the seller of the option is going to lose his money. He doesn't. You don't have to give him any because you're making more money than what you're giving him. So he's going to go into a loss. He's going to have to give you money. But the market has to go up fast enough by expiration to be above that line. So right there, that's your break-even point. So the market basically has to stay above that little white trend line right there to be profitable. And see, it's easy to get above there right now. It's easy to come up in here. This is all profit. All profit, profit, profit. Oh, you're making money. Oh, you're rich, rich, rich beyond your wildest dreams. Everything up in here is money. Everything down in here, this is loss. This is where you lose money. Now, the max amount of money you can lose is the $1,740. So it's not going to go down here. There's no loss down here. It's only a loss is in that little triangle right there. In fact, let's draw that little triangle for you. All right, delete all arrows. Let's delete this one. So let's take a little triangle tool, and we'll just make it easy for you. From here to here to here. That's your loss zone. If your option stays in, the price of the market goes inside that little triangle, you're losing money. And of course, if it goes down here, you lose money too. You just can't lose any more than what you paid for the option. So you actually have kind of a buffer down here too. So we go down 1,782 there, 1,782. That's going to be the full loss, 1,000. Otherwise, you get a little bit, right? You liquidate it, and you might get some of your money back. But by the time it hits here, if it's below that line, you lose it all. So it can move around inside of here and still be okay until you get all the way out here. If you lose it down in here, anything below there, you lose all $1,700. That's just how it works. So you don't get nothing, okay? So it needs to stay above there. This is your profit zone up here. Make money, make money, make money when you buy a call. If it doesn't, if it starts going down here or it looks like it's going to go down, just get out. It's the same thing as having shares. If it goes down, get out, except for the maximum amount you can lose is $1,735, which is going to be right there. It's going to be right there. That's the maximum amount you can lose right there. If the market is anywhere down here, then you've lost everything. If it goes in here, you're still going to lose everything down to here, but you might make a little bit. You're not going to lose the entire $1,787. You might make a little bit, might make $100 or something, but you're still lost because you paid $1,700. So you're going to lose $1,600, right? So it's still losing. It's still a losing trade, just not the full $1,787. Okay, so that's how it works. Anything above there is profit. So it's got to stay above there all the way out to here. That's a call. That's it. Very simple, very easy. Nothing hard about it. So now let's come in and do we want to buy Apple call? Do we think Apple's going to take off and go to the moon right here? If we do, we want to buy an option. And why would we buy an option and not shares? Well, if you put the shares in, it's $25,000. So the option is going to make the same amount of money as the shares, but you don't have to have nearly as much money in. Why? We only have to put $1,780 in, and it's going to make the same amount of money as if we had $25,000 in shares. That's your leverage. That's the advantage of options. That's why you trade options, is because you get that advantage. You only have to put up $2,000, $1,700 instead of $25,000. You're going to make the same amount of money by expiration. Now it's going to be a little bit different in between, right? It's not going to be as much money in here because of the delta, but once delta goes all the way to 1.0, which is what will happen at expiration, you'll have the full 100 shares value. So you will have made just as much money with the option as you would have made with 100 shares, but you only had to put up $1,700 instead of $25,000. That's it. Very simple, very easy. Let's just go into a whole bunch of them. All right. That's how you do it. Oh, we're just going to mark it into this one. All right. So is it going to let us mark it in? Probably not, because we just barely did it. That we did a long time ago. Let's reset it. So we're going to come in here. And we've got 2,435 on the open interest. Volume is not right. That's at 0. That can't be right. So we're $20 on the spread. Let's just come in here and hit market and say, okay, let's see if we can give it to us. Yep, they gave it to us. Now we got a long call. There we go. What if the market goes down, Lan? We'll learn about that on Wednesday. All right. We can come, well, you could buy a put option, right, to protect your downside potential. That's called a straddle or a strangle. So there's different strategies. You can come in here and say, well, put option is the same way. Let's come over here and talk about put options for a second. So we'll come in here and let's go to one Amazon. Let's go to Amazon. Oh, well, there we go. Amazon. Well, Amazon looks like we want to buy a call, don't we? We don't think the market's going to go down. Let's come in here and we're going to buy a call. We're going to go 122 days out. 122 days out, we're going to buy a call. We come in there. There we go. Very simple, very easy. Now, you could buy the call up here, right? And it's a lot less money. The call at the money, remember, this is at the money. The ones that are up here, these are out of the money. The ones that are down here, these are in the money. So if you look at the table, the in the money's down here, a lot more expensive. Out of the money, a lot less expensive. That's because the market has to move. The market has to move up to that point just to get to where the market, the shares are even starting to make money. But it's less money, so it's less money and same leverage. So it's oftentimes you make more money with an out of the money option, but at expiration you make less money. So let's come in here and we're going to go from this, our little target. Well, we got to do our, how much? $1,800. So $1,800 on the shares, your break even point is right 1,800, but it doesn't even start making money until right here at expiration. It'll start making money right here immediately. It'll go up, just not as much. Why? Because how many shares is represented by it? Well, if it's up there, your shares that are being represented by the option, if you buy the option up there, remember, it's only got 43 shares. It's making money, not 56. Because delta tells you how many shares is making money. So it's making money as if it had 43 shares. If you were at the money down here, it's making money as if it had 56 shares. But still, at expiration, it's still 1.0. So you paid less money, but the difference is, where did it start making money? It didn't start making money till up here, at expiration. But right here, it'll start making money immediately. As soon as the market starts to rise, it'll go up, but it only makes it at 43 cents per 43 shares per 100. Now, if you go to the other direction, you go all the way down here, you go in the money. Now your premium goes way up, $2,700. You have to pay more for it. But you're also making money as if you had 68 shares instead of just 56 shares or just 43 shares. It's making more money. 68. You just bought more money is what you did, is you bought more delta. You bought more delta. So this is less delta, 43. So less delta costs you less money. Either way, the market goes up. You're like, I don't understand, Alan. Okay, you want to do it here, I'll make it easy for you. We're going to come in here, we're going to buy one here. We're going to buy one up here. And we're going to buy one down here. And we're going to spend $3,000 on this one, $1,800 on that one, $1,000 on that one. They're all three the exact same. All three the exact same distance away. This is in the money. This is out of the money. This is at the money. That's how you learn. Oh, okay. I'm going to come in here and I'm just going to see if it'll market me into these things. I don't know if we have enough money to do this. Looks like we do. All right. So we got one of each. We got an out of the money, an at the money, and in the money. Now we're just going to let him go. It's demo account. We don't care. We're just going to see what happens. But Lan, what if you buy one way out of the money, way up here? Well, let's put one on, see what it does. Oh, that's a good idea. Put it on, see what it does. Right, now we got three here. We got one way out of the money. What about if we put one way in the money? Just do it. Find out what it does. You can pay $4,000 for it, but it's way in the money. Put it on. Oh, we don't have enough money to put that one on. So that's how you're going to do it. All right. That's how you're going to learn. You're going to come in here and you're just going to put them on. Now, if we want to do some more, we've got them all on here. We're out of money. We can't go buy any more anywhere else. So let's go ahead. I'm just going to exit all these. So we can go put them on somewhere else. All right. Now we got some money again. We'll come down here and let's go to a different one. Let's go to Disney. Oh, Disney's dying on the vine. Look at them go down. But I think they're going to turn around and go up, you say. I don't know what they're going to do. I don't know. Why don't I come in here and buy a call option? Okay, buy a call option. That way, if they go up, I make money. If they don't, I only lose $755. But what do they keep going down? Buy a put option. Buy a put option. Now, if they go down, you're gonna buy a put option for $437. That's your insurance policy, and you bought a call option $755 in case the market goes up because you think the market's going to go up. So if you think the market's going to go up, this is just called a debit spread. So what you've done is you've just come in here and said, well, my call option tells me I'm going to make money if the market goes up. And this one says I'm going to protect myself and make money if the market goes down. All right. You can put it right on top of it if you want to, just like that. You're going to pay $757 for the call to go up, and you're going to pay $645 for the put to go down. This one's going to make money if the market goes up. This one's going to make money if the market goes down. This one can't lose any more than $642. This one has unlimited profit potential, but you got to cover all the premiums. So you have 122 days. So if this thing goes to the moon, like maybe you anticipate, oh, Disney came out with a new movie. I don't know, whatever you think. But you think that market's going to go to the moon, you could put this on. Now you're protected to the downside. If it does keep going down, well, it's not that you're not going to lose money. You're just not going to lose as much money because you got an insurance policy making you money down here. And you're losing it here, but you're making it there. So it's kind of neutralized, right? So if you're wrong, it's very little money. And you can get all your insurance back. You can get all your premium back. You say, well, I was wrong. Get out. If it turns, it keeps going down. Oh, no, I really was wrong. How much longer are you going to wait? Well, the MACD looks like it wants to turn. It went green. Okay, well, wait a little longer. Maybe it'll turn and go back up. If it does, then you can get rid of your insurance policy and just keep your long position. See how that works? It's very simple, very easy concepts. That's it. That's the whole thing you can do with options. Now, the only difference is that you can come in here and you can put them at different. We did them in the money, at the money, and out the money, right? You do one here, do one here, do one here, and we're going to find out what all that does over time, right? But you can do the same thing here. You can come in here and say, well, what if I come in here and I buy a call, and then I buy a put, but the put, I only keep it for 10 days. It's out of the money. Or maybe I put it way down here. What's going to happen, right? It's out of the money because it's a put. It's not in the money. That would be a call. So it's out of the money. If you want to in the money put, you have to put up here. In the money puts would be up above, right? So that would give you a bigger delta up there if you go to the puts. See, we have a bigger delta up there. So that means you put it in the money, you're going to pay more for it, $927, where this one you're going to pay $757 is your call. The call is going to make money when the market goes up. But the insurance premium, you're going to pay $927 in case the market goes down, but you're going to be in the money. So you get a delta of 55 versus the call option that you're doing. Let's do both of them. Let's put them both on here. So now we have a call option sitting with a delta of 43 and a put option with 55. So the put option is going to actually make more money than the call option is going to lose. If the market goes down, you'll actually make more money. This is actually make more money if the market goes down. Because you got an in the money put, which has a higher delta. But if you're just using it as insurance, you don't need to have a higher delta. You can put it right at it. You put it right on top of it. Won't it delete it? No, because it's a put and a call, two different types of orders. If you wanted to make it get rid of it, you'd have to put on it. You buy your call and you're in the market, then you'd have to sell a call with the same time frame, right at the same price. Then that would liquidate it out, or you can just hit liquidate and then that takes it out too. But you can sell the opposing, and then that'll take it out of the market. But this is not the opposing. This is a put option. Remember, we can buy to open or we can buy to close. We can sell to open, we can sell to close. Because you got two kinds of options, puts and calls. You can buy a call or you can sell a call. You can buy a put or you can sell a put. So a put is not a call. Therefore, you can put it right on top of it, just like that. And you can buy a put and you can buy a call right at this exact same strike price. That's how it works. That light bulb moment coming on for anybody yet? Sorry, I didn't see that in time. Which at what point are you saying that? What put would you buy to reduce the risk? I think I kind of answered that. You can use however much risk you want to reduce by the delta. Remember, the delta is the number of shares that your option is covering. So if you've got a long position, okay, he says I covered it. So if you got a long position with 100 shares, well, you don't need to cover it 100% because by the delta going all the way to expiration, it'll be covered at 100, but it's going to only cover a put option at the money at whatever the delta is, 43 cents or 43 shares. All right. So what's another fun thing we can do? Let's go look at another market. Let's come down here let's go look at Google. What's Google doing? Look at Google. What do you want to do with Google? Google looks like it wants to go back up, right? I mean, it's the same thing that happened with American Express. Remember, we were sitting here. American Express looked exactly like this. We drew all our trend lines in here, and we're like, oh, wow, man, this thing's coming in here. Problem is we got a nice little head and shoulders in here, don't we? Head and shoulders is generally bearish. Tells the market's going to come down. But, hey, we think the market might go back up. Might go back up. We think Google's good, man. They're great stuff. They're going to go back up. But what if they do go down? What do we do? Well, you can do it several ways. Come in here and buy you 100 shares. Buy you 50 shares. Buy you 50 shares of that, Watch this. Let's do something a little bit different than last time. We're going to buy 50 shares. We're going to buy 50 shares. Let's just go buy them. Boom, just like that. Okay, $15,000 because it's trading at $30,000 or $300 a share. If we bought 100 shares, we would have to pay $30,000. But we're only buying 50 shares, so we only have to do $15,000. So we're in at $15,000. Everybody understands that concept, right? Okay, now I want my insurance policy. Protect myself to the downside. Well, I'm going to buy a put because I make money if the market goes down if I buy a put. So I'm going to come in and I'm going to buy a put. And where am I going to buy it? Well, I'm going to buy it to where I have a delta 50. Where's the delta 50? Well, delta 50 is right at the money, right there. Now I've got a delta 50. I'm going to be covered 100%. And convexity, if the market starts to fall, is going to increase. I'm going to actually make more money on my put option than what I'm losing on my shares. It's actually going to cover me 100% on my shares. And if it goes down, make me a whole bunch more money. Pretty cool, right? Because it's a delta 50. Is it a delta? Well, right now at that money, it's sitting at delta 43. Move it up one. See, I move it up, right? You can move the options around down here. Just grab them down here in the little window. Move them up. Move them around. There you go. See that? Just like that. Let's put it right there. That's a delta 43, and that's a delta 57. And we got 50 shares, and that's a delta 57. Let's put 7 more shares on. Come back over to our trading tab. Put on 7 more shares. 1, 2, 3, 4, 5, 6, 7. Buy the market. Okay, now buy the option. Edit. We're going to come in here and we're going to buy the option. We're going to go midpoint market and just buy that. Now we have 57 shares and we have an option that has 57 delta. We matched the delta with our options. How's that? With our shares. So now we got a perfect hedge. We're perfectly hedged. And if the market does fall, we actually make more money on our put option because convexity will increase the delta. As it goes down, it'll go delta 57, 50. Let's turn them off. Puts only. We're at 57, 40, 39, 30. It's going the other way. In the monies. Let's do in the monies. Yeah, well, just the deltas. Come on, the put options. Okay, so it's going to go 46, 50, 53, 57, 61. So it'll start to increase. Go from 57. We're at 57. So right there. So it'll go to 61, 65, 68. It'll just move up. That's the name of the game. That's perplexity. So it's perplexity. It's perplexing. That's the delta or the convexity. So it's going to go work in your favor, make you more money, even if the market falls. And you have a perfect hedge at that point. Pretty cool idea. It cost you less money to do it because you only had to buy 50 shares, 57 shares of the underlying stock instead of 100. Lan, I got a better idea. What if we do this? Let's exit out of here. Let's come in here and do this. So we're going to come in and we're going to go, let's exit chart, go back to our trading tab, exit chart. So now what we're going to do is we're going to match up. I don't have enough money to buy 50 shares of Google, but I still want the insurance. So what can I do? So we're going to come in here and we're going to go, I'm going to buy, I can only afford 25 shares of, in fact, I can't even afford 25. I'm going to do 20 shares, $6,000. I can't even do that. I got $5,000. I can afford 16 shares. Let's do 5,212. Okay. I can do 17 shares of Google. That's all I got. 17 shares. Okay. How are we going to do this? So we're going to come in here. We're going to buy the market, 17 shares of Google. Now I want to protect those 17 shares. Most people will just come in here and put a stop in here at 17 shares and say, well, if it comes down there, I'm going to get stopped out and I'm going to lose the amount of money, $1,343. Ah, that sucks. You just got my stop in there to get me out if I'm wrong and just lose my $1,700. Well, let's protect it with an option. You could probably buy an option for less than $1,300. So let's get rid of this stop. We don't want that. Now we're going to come in here to the option and we're going to say, I need 17 shares covered. Well, that means all you need is 17 delta, a 17 delta option. So where can we find a 17 delta option, put option? Well, we're going to find it way out of the money, right? Way down here. There it is right there. Look, there's one. It's going to cost us $690. That's a lot less than our stop. It's half. So we're going to come in here and we're going to buy that little baby. Where's it at? It's way down here. But that doesn't matter to us. We don't care where it's at located on the screen because it's going to do a 17 share. So it's going to make as much money or lose as much money as the 17 shares that we bought. So this is now covered, right? We have the protection to the downside. I think that deserves a drink of tea. That's a pretty cool idea, right? Pretty good. That's the way options were designed. That's why they do it that way. So if you can't afford 100 shares, but you want to have an insurance policy on an option, well, $692, you're now covered. 17 shares. This says it's a 260 put, but it's an out of the money put, so it's got a delta of 1.7. There you go. You're covered. And if the market does go down, what's going to happen to the delta? The delta is going to go up, isn't it? So then you'll be covered at 18, then 19, then 20. You'll start actually making more money because of convexity. Because you make more money as markets go in your favor, and you lose less money when markets go against you. So if the market starts to go up, well, your delta will go down 16, 15, 14. So you start losing money at 16, 15, 14, and your underlying shares will start going up as if they own a delta of 1.0, right? Because shares always operated at a delta of 1.0. And the options don't ever operate at a delta of 1.0 until they're a long ways in or in the money, or until they hit expiration. At expiration, they're always 100. They're always a delta 1.0. But right now, it's sitting at a delta of 1.7. So you're protected to the downside, and if it goes up, well, it loses money more slowly, and you can eventually say, well, it's going up. It's doing what I wanted. It's doing what I thought. Take your insurance off. Get your premium back. You got 100 days. It's going to go only delta, right? It's going down slowly. There you go. Insurance policy. Get your premium back if you don't need it. You don't have to spend the whole $687. It's not gone. It's sitting in that other dude's account, and then when you liquidate it, I want it back. He has to give it back to you. That's how it works. That's how it works. All right. All right, guys. I think we've run the gamut for today. Let's come in here and exit chart. And I'm going to let you go, and we're going to meet you again tomorrow afternoon at 1 o'clock. We're going to do a little day trading. I think it'd be fun to do a little day trading with options, don't you think? We're going to do a little day trading. That's what we do in the after hours, or in the afternoon hours. We go do a little day trading. And so we're going to do a little day trading tomorrow afternoon at 1 o'clock Mountain Standard Time, and we're going to do it with options. So we'll trade the S&P 500, the SPY, and we'll trade it in the futures market, and we're going to trade options to day trade. It's fun. Show you how it works. Okay, we'll see you then. Anybody, you guys have any questions? Says, can I use other provided option software with the same functionality? Well, lots of other software programs have options, so there is that. But the functionality of being able to drag them and drop them on the screen and do all the neat stuff that we're doing with Track and Trade, that's very unique to Track and Trade. I don't know any other company that does that. So they usually use those little Christmas-like charts with little reds and greens on them that really don't mean anything. They're just cute. So, Track and Trade that's what it's famous for. We used it at the Chicago Board of Trade to teach options with. It's been around for a long. That's what Track and Trade's famous for, is building the little options models right over the top of the chart, and it's like makes all the difference in the world. So rather than building them off in some little side window where you have really no visual relationship to the underlying chart, which is really hard actually, we put them right over the top of the chart with Track and Trade, and now you build your models right on the chart, and you can see the relationship between where the chart's moving. Because we're technical analysts, right? We're not fundamentalists. We're technical. So we look at the technical side of the chart. We look at the chart, recurring price patterns, mathematical models, indicators, delta cone of probability, Fibonacci, Elliott wave. We do that kind of math. So we need to see, because we're technical analysts, we look at the chart, we need to see where the options are in relationship to our Fibonacci projections, retracements, our recurring price patterns, our trend lines, all that stuff. That's very important to us. So the options working in relationship with that concept has to be laid on the chart. You can't do it in some window off to the side. That's fundamental analysis. We're like, well, we believe the market's going to go up. Why? Well, because Donald Trump said it was. Okay, I'm going to go build my options model over here based on Donald Trump saying it's going to go up. It has nothing to do with the price of the chart or the chart movement. It's two different schools of thought. So it depends on how you see the markets and how you like to trade. Are you a chart trader? Are you a technical analyst? Do you like to look at charts, trends, recurring price patterns, mathematical models? Well, then you want your options to be laid over the top of your chart. If you're a fundamental analyst and you just believe that, all the fundamental news is the only thing that's important. Oh, we got a war, therefore stocks are going to go up. I'm going to go build my option strategy over here off the screen because it really has nothing to do with the price. Well, I think personally, I think everything has to do with price. So just two different schools of thought, and it depends on how you like to look at your charts. All right, that's it. If you guys have any questions, I have one little thing to invite you to stick around and watch. First of all, the software that I am using.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's it. And then, of course, Claire wants to let you know that we changed the name of SFO Pitt News Magazine, so I'll let her tell you about that, and then we'll be done for the day. How many of you have Pitt News Magazine, or SFO Magazine as it is now? Here we go. Let's let Claire tell you.
Hey, everyone. It's Claire. Okay, so before we get into anything else, I need to get something off my chest. And I'm a little nervous saying this out loud, so just stick with me here. You might notice something different. Pitt News Magazine has a new name. And yes, this might be my fault. I may have gently, very gently, nudged Mr. Turner into a conversation that turned into another conversation, which somehow turned into a full-on name change. I swear that wasn't the original plan. I was just asking questions. Innocent questions. Like, what if the name told people exactly what they're getting? Totally harmless. So, Pitt News Magazine is now SFO Magazine. Stocks, futures, options. That's it. That's what we do. No mystery, no decoding required. Now, full transparency. I'm still a little unsure if this was the right move. I mean, Pitt News has been around for a long time. It has history. It has personality. And Mr. Turner definitely gave me that look when I first brought it up. You know the one. The I'm listening but I'm not convinced look. But the more we talked about it, the more it made sense. SFO magazine tells new readers exactly what they're opening before they even click. No guessing, no assumptions, just clarity. So if you're wondering who to blame, hi, it's me. If you love it, I'll absolutely take credit. If you hate it, I'll be hiding behind my keyboard for a few weeks. Seriously though, we hope you like the new name. Same magazine, same content, same slightly opinionated takes on the markets. Just a cleaner label on the front. Let us know what you think. And thanks for sticking with us. Name change and all.
All right, guys, that's it. Name change and all. Hopefully you guys will join us for SFO Magazine, Pit News Magazine, and we'll catch you tomorrow afternoon at 1 o'clock Mountain Standard Time to do a little day trading with options. And then again, tomorrow evening, Wednesday evening at the university is our class, and we'll go back down there and we'll work on the class. All right. See you then. Take care. Have a good day.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.